Hey, what's going on, guys? How are we? How is everybody? There's already a number of you on here, which is great. Happy New Year, by the way. Happy New Year to every single one of you. Thank you for being here on this Sunday evening. This is the first live of 2021. So I'm really excited, to be honest. I've been looking forward to this for a very long time because the last one that we had in December, on December 13th, we had over 100 people here, and yeah, I'm excited to see what we can do today, what kind of questions we have coming in. There are tons of questions already, so we're going to get to it, basically. I just need to do one other thing because I just completely forgot to do it. So I'm going to do that, copy that right now. Okay, cool. Right, so guys, pop in your question. Am I okay on audio, by the way? Just give me a thumbs up. Let me know in the comments if this is loud enough for everyone, because I watched back the last one from December, and someone asked me to increase the volume and it sounded a lot better. So just let me know that this is okay in terms of the volume on the live, on the stream. Perfect. Okay, cool. Right, so we have a couple of questions here. So let's start with William Boardman. Will Twitter bounce back from Trump being banned? It's a private company at the end of the day. I think they're going to get a load of backlash, obviously, but capitalism, right? That's the whole thing. They have the right. He agrees terms and conditions, and you could say it's censorship, which I guess it is to a certain extent. But at the same time, who knows? Who knows? It's a call that I definitely wouldn't have wanted to make if I was heading up Twitter, especially with everything that's gone on over there over the last sort of few years. But will they bounce back? I think as a company they'll be okay. As a company, I think they'll be okay. I think this will kind of like blow over in the not too distant future, and this will be a long distant memory. Free your finances. What's going on? How you doing? Welcome. Kruger, how are you? What's your thoughts on using buy-to-let property as an investment vehicle? Buy-to-let property, I mean, you have to obviously make sure that you've got all of your ducks in a row, because you need obviously deposits and that kind of stuff, and you need to understand what your rental yield is going to be. Locations obviously very, very important, particularly now with COVID, furlough. I know that many landlords have struggled with obviously the fact that people have struggled for the last year, and it looks like certainly for the first maybe 3 or 4 months of this year, we're going to experience exactly the same thing, with people struggling with furlough and probably not being able to pay rent. I know that I coach, and a number of my coaching clients have had to have conversations with their landlords about, trying to take a little bit of a break. I mean, it's great if you've got a mortgage, you can take a break. So that's definitely a consideration. But with that being said, though, and the property market has held up relatively okay. Now could be a good time, or this year could be a good time to pick up some potential deals on the property market. But again, you just kind of really need to know what you're doing and what you're looking for, being able to work out what your yields are. But buy to let as an investment vehicle, really, really good opportunity potentially. I think it's all down to preference as well, to a certain extent. I mean, I'm not that much of a property guy myself. Because of obviously, it's a lot of work, especially if you haven't got a management company looking after it. But you just need to consider all of the pros and cons and decide what's going to work best for you. And that's the whole point when we talk about investing, right? It's coming to a decision that best suits you. Which emerging market or ETF Vanguard or iShares? I'm not really sure what you're asking me there, Stephen. Let me know. Calm Meditation. Hi Pete, love the channel. I'm a student who wants to make a start on saving for a house. I've already maxed the lifetime ISA for this year, as well as having an emergency fund. Mate, you're in a really, really good position there. Savings and investments. Are there any other options other than cash if I want to save for a house in 3 to 4 years' time? Yeah, so you're in a really good position. If you've already maxed out your lifetime ISA, then you want to keep your money in an ISA, really, to be fair. So you've got a couple of things that you could do. So bearing in mind that the new tax year starts on April the 6th, so we're about 4 months away from it, you could, if you wanted to, invest some more money into a stocks and shares ISA, because your lifetime ISA is only 4,000 of your £20,000 allowance. So if you've got another 2k or 3k lying around, you could either put it into another stocks and shares ISA, So that will be invested in the market for you. You could then transfer that into a lifetime ISA come April to use your new allowance and get obviously your bonus. Or if you don't want to invest it, you could put it into a cash ISA and let it just sit there until the new year, new tax year, I should say, and then transfer it into your lifetime ISA. But you've got a really, really good thing going on there if you've managed to, max out your lifetime ISA already, and you're already on your journey. I would just say though, because you have got a 3 to 4 year time horizon, just be mindful that if you do invest, you need it in the near to short term. So you really want to be mindful that you don't go into something that's going to be high risk, because you potentially have the risk that you might lose your money, and you don't really want that because you need it for your deposit. So just be mindful of that. It's an option, but you do have to weigh up the pros and cons of doing that if you went down that route of actually investing the money in opposed to putting it in a cash ISA. Millie, hi Pete. I would like to open a lifetime ISA account, but I'm not sure who to open an account with. I'm 90% sure I want to go with Skipton Building Society. I did look into Moneybox, but the reviews put me off. Okay. I think I had an ISA. So I had my emergency fund in an ISA with Skipton Building Society last year, and well, for this current tax year, and they had some really, really good rates actually. So Skipton are good. I haven't seen the Moneybox reviews, to be honest. So I think with all companies, they're always gonna have issues and stuff. But Skipton is a good one. If are you looking at a lifetime, a cash lifetime ISA or a stocks and shares ISA? I assume you're thinking a cash lifetime ISA if you're looking at Skipton Building Society. I don't know what the best rates are at the moment out there, if I'm completely honest, because it's interest rates are really, 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 really bad right now. If you message me on IG, and I'll have a little look at what rates there might be out there on the market at the moment, and I'll let you know. Martin Hutchinson, hey Pete, how you doing? I'm really, really good, thank you, mate. Love your intro music, thank you. Finally found a use for it, so that's good to know. Thank you very much. Let me just go back up here because I think I've just skipped very quickly. Thinking of Vanguard stocks and shares ISA. Is it better to invest one big lump sum instead of every month? Because with the latter, you're buying according to the ups and downs of the market over the year. We were just talking about this in the members live that I do every Sunday with my members. So if you're not part of the membership group here on YouTube, it might be worthwhile. We meet every Sunday, private Zoom room where you got a Discord channel as well. So if you have a lump sum over the course of 2, 3, 4, 5 years, you will end up better than if you invested on a monthly basis, because you've got to factor in the fact that a lump sum investment day one, if you are able to, you've got longer in the market essentially with a bigger amount of money, so you'll make more money than buying in every single month and benefiting from pound cost averaging. All of the statistics tell us that's true. So you'll be better off working with investing the lump sum straight off the bat, as opposed to feeding it into the market over a period of time. There are a couple of other things on here. Audio is good. All right, okay, cool. Let me just catch up with myself. How many stocks would you suggest for a solid dividend portfolio? Diversification is really, really key. I mean, I think you begin to diversify your portfolio the minute you start to have like maybe 10, 12 stocks altogether. But I know that if you look at maybe some of the professional investment houses that I've certainly worked for, and some that I know, some of them will hold at least 20 to 25 stocks maybe sometimes as well. But again, it does depend on what your goal is. So what is your goal? And do you really intend just to invest in dividend stocks exclusively? That's a legitimate question, by the way. Particularly if you're not looking for income and you're looking for growth. That may not be the most prudent of approaches, because when you have a criteria where you say you only want to invest in dividend stocks, what you're doing is you're narrowing down and you're reducing quite significantly the options that you have to invest in, because your selection criteria is companies that only pay dividends, which means that you're going to miss out the likes of Berkshire Hathaway, which is Warren Buffett's company. You're going to miss out the likes of Tesla, which are doing really, really well right now. So just a couple of things for you to think about. Benjamin, Great channel. Trading 212 investment pie. Is it wise to have this work automatically as the price changes? As the price changes, does affect whether it's worth doing it, or is it not wiser to monitor your price and buy yourself? You can do. I think the whole point of the pie in Trading 212 was that you could select or build your own portfolio essentially. So you would say, right, I've got 10 companies here that I want to invest in, and you build up the proportion of your cash that you want to have invested in your money, and it just does it on autopilot. Now, if you're trying to basically monitor prices and buy the stuff yourself, then you could be sat on your phone or at your desk pretty much 24/7, 7 days a week. The whole point, if you're investing, surely is you've done a little bit of research on the companies that you want, and you've selected a batch of companies, right? So you've got your 10 or your 12 or your 15 companies, and those are the companies that you're actually looking to buy and invest in, with the idea that they are going to be worth more money in the future than when you actually bought them with at the same time. Now, if you're trading, this is completely different. And trading and investing are two different things. So the pie is great for ease. You select the companies, you allocate your proportions, you send the money to Trading 212, it automatically gets invested. If you don't want to spend a lot of time looking at prices and looking at charts, then that's perfect for you. If you do though, then you really could, you're potentially going to spend a lot of time worrying about prices. And in my experience, if you're going to be buying companies and you're worried about the price, you're never really going to invest, because the price will be up one day, will be down another day. So you need to try and see if you can strike the balance. Personally, that's what I think. But again, with this kind of stuff, I don't know your circumstances directly, so please just bear in mind that, don't take it as, Bible, essentially. I think I've got buffering issues. This is telling me that I have, and I shouldn't have. It might be something going on with my Wi-Fi. Apologies, guys. But yeah, Benjamin, I hope that helps. My brother's on here. How you doing? William, audio perfect. Okay, cool. So Lewis Atkinson. Hi, Pete. I hope you had a nice break. I hope to be an investor and not a speculator. Therefore, how does a new investor not financially trained evaluate stock? It could be... Right, okay, so there are a number of ways that you can evaluate stock, and you can have a look at financials just to find out whether the company from a financial point of view makes sense. So are they making profits? Are they paying dividends? Are they actually making money? What does their balance sheet look like? So you've got the financials that you can have a look at. You do need to do foundational research though. So you do need to know what the company is all about. You need to understand what product they're actually manufacturing, what service they're providing, what their competition is like, what the market is like. What does the economy actually say about the company? How does the economy potentially impact what the company does? Particularly now with COVID. All these things you need to understand. If you are a first-time investor, Lewis, my personal thought is you shouldn't be looking at picking stocks yourself, because there's so much that you can get wrong and it can be very, very technical. You would probably be better off just starting off, maybe purchasing like an S&P 500 fund, just to kind of get yourself comfortable first and foremost, and then start doing some research around how you actually properly have a look at researching stocks to buy. The biggest thing that I would say to you is, what are you investing for? Are you investing short-term, long-term? What are your goals? Are you looking for growth? Are you looking for income? Are you looking for a mixture of both? Because the answer to that question will determine whether or not you should buy a particular stock, or how long you hold it for, or what level of risk you should be taking. You have to also bear in mind that if you're looking to pick your own stocks as well, you have to think about how you're going to manage your risk. You need to think about diversification. There's a lot to think about. It's very, 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 very technical if you want to do it properly. So Lewis, just bear that in mind. I hope that was helpful, but, try having a look at, index funds, maybe some ETFs, for example. Those are just very, very easy things that you can invest in, very, very low cost. you'll get exposure to some very, very good companies. So you'll get exposure to the likes of, Tesla and Amazon and Facebook and Microsoft and all of these big companies that and you would have heard of. But you won't have to worry about doing all the technical analysis and actually worry yourself with actually picking the stock as well. So just bear that in mind, because that's really, really important. I think this is still buffering. Let me just try something here. 1 second. Okay, it keeps going in and out. Let's just crack on with these questions. Apologies, guys. Might have a thing with my my connection here. Okay, so we got Lewis Ryan. Who did you do your advice qualification with? So I did my advice qualification with LIBF, which is the, I think they've changed names now, but you can do it via the CII or you can do it via the LIBIF. The LIBIF do it in a different way to the CII. It's a bit more practical, so you get to write a multiple choice exam. You get to write a suitability report, which is a practical piece. So there are 3 papers altogether. I managed to get it done in, I think, in about 8 months or so. If you go down the CII route, you've got to do a few more books, a few more modules. So if you're looking to do your own qualifications for financial advice, have a look at CII and look at LIBF. Those are the two that are the main providers in that regard. Jay Singh, as a beginning investor, I have maxed out my stocks and shares ISA. What investment account shall I put future money until the tax year? So, right. One of the best things that you could do is you could put your money into a general investment account, and it's an account basically where you can just put your money in and you can invest that way, or you use it as a holding pot. But if you're using, I don't know who you're using right now, but if you're using Trading 212, just put it into a Trading 212 invest pot. Or if you're using someone like Wealthify, they actually have accounts called general investment accounts. So you can put it into a general investment account, and when April the 6th rolls round, you can then just literally just transfer the money straight into your ISA. That's what we used to do when I was advising, essentially. We'd have money sat ready to go for the new tax year in a general investment account for clients. V-Day, hi Pete, hope you're well. Do you think it's a good idea to invest in airplane companies, stocks, e.g. IAG, now assuming they'll bounce back in the future when travel is allowed again? Really, really good question. They're called recovery stocks. So if you have a look at IAG, you have a look at some of the cruise lines, those kind of companies, they'll be classed as recovery stocks. There is an argument to say that they could be a really, really good buy right now, particularly, if you take, for example, British Airways. You have to ask yourself when you're trying to make a decision on this, you need to ask yourself whether you think a company like BA will fold. With BA specifically, I don't think they would. My personal opinion is that they would probably receive a government bailout, so they wouldn't fold, they wouldn't go bust specifically. And then you just need to think about, the vaccine is being rolled out. Boris, bless him, for good or for bad, he is really putting some back into trying to roll out the vaccine. So I think we've vaccinated like 2 million people already. So when everything gets back to normal, will these companies recover? Big chance that they will. Will they definitely? I don't know. But there is a good chance that they would recover really, really nicely and get back to somewhere similar to where their stock price before. So from that point of view, you could say that they are a good buy. But as with all things, it's all about making sure that if you do go and buy IAG, that you make sure that you are comfortable with the level of risk that you're taking, and just acknowledge that there is still a risk that they don't recover, that they do go bust. Now, IAG, have a look at what companies are actually in there, and make a decision from there. But my personal thought is, with IAG, I don't think they would go bust. I actually hold some of the IAG stock. That doesn't mean that you should, but those are just some thoughts for you to consider. And that will be the same for if you're looking at cruise stocks as well. So like Carnival, for example, the same logic will apply. Right, let's have a look at this. Let me just go back up again because I've just skipped. Let's go back. All right, there we are. So Stephen Smith we've got here. So what's Stephen saying? Stephen, is it best to pay down my mortgage with redundancy considering how low interest rates are, or invest in shares or pay into pensions funds at 48? Mate, this is a really, really good question. Okay, so there are a number of approaches that I would take thinking about this. The first one is interest rates are pretty low. You are right. However, with interest rates, because they are so low, does it make sense to pay off your mortgage with a lump sum from your redundancy? There is no right or wrong answer to this, and the people that I know that have done this will defy the logic that I will explain now. So if you look at your mortgage rate, if your mortgage rate is, say, like, I don't know, 2% on a fixed rate, right? Or if you're on a standard variable rate and it's less than that, maybe 1.4, something like that. The amount that the mortgage is costing you in interest at this point in time is really, really low. It's small. It's minuscule compared to the amount that you've borrowed. So you're not paying a ton of interest like you would do if your interest rate was like 3 or 4%, right? Now you contrast the low interest rate with the idea that you invest in the market. And granted, you have to be comfortable with an element of risk taking when you invest in the market. You can manage your risk. So you could, for example, say, right, if I invest as a cautious investor and have a small exposure to the equity markets and pick an investment that has some bonds in there to give you a bit of safety, that if you were to return maybe 3 or 4%, that you would make more money on the stock market having invested the lump sum than actually paying off the mortgage. You have to sit down and do the calculations and do the assumptions yourself here. So again, there is no right or wrong answer with this. Really, what it boils down to is, what do you feel comfortable doing? Because you could pay the money into a pension, which would be a good way of you doing it, but you need to bear in mind that you are 7 years away from being able to access your pension. With that being said, though, you probably would have paid tax on your redundancy. If you pay a lump sum into your pension, when you hit 55 in 7 years' time, you'll be able to take a quarter of the total value of that pension out completely tax-free. So you could then, if you wanted to, use that tax-free lump sum to pay off your mortgage or a sum in your mortgage. It really depends on what your priorities are like, Stephen. Whether you are interested in clearing the mortgage before you get to retirement date, I don't know. But it's a difficult question for me to answer directly with a straight, you should definitely do this. I don't know your circumstances, but I hope what I've just explained there gives you something to think about, essentially. You know, for many people that I know, they feel more comfortable paying off the mortgage because, well, it's their mortgage, it's their home. They know that no matter what happens, the house is going to be there and it's an asset increasing in value. So you may decide that actually, once you've done the numbers and thought about, you know, if you returned, 3 or 4% in an investment for a period of time and you were going to make this much, you will need to decide whether that potential gain outweighs the peace of mind and the comfort that you might feel paying off a lump sum on the mortgage. Really, really difficult scenario to be in, Stephen, but I hope that gives you something to consider. But if you want to chat with me separately, just feel free to ping me a message and stuff like that as well. RS, if I had a 2K loss this financial year, can I carry over next financial year and have 12,300 plus 2K from losses? So profit 14,000 before you need tax. So you can carry over losses for capital gains tax purposes. But really, this isn't a question for me. You need to be speaking to an accountant. An accountant needs to advise you on that because they will do it in a certain way. But you can carry forward or you can offset any capital gains or losses against your capital gains tax. But you do need to speak to an accountant. That's not one that I would feel comfortable giving any kind of like nuance to. JX, thanks Pete for your help. Left this comment on one of your 212 videos, and you said it was good. A good one for Sunday is creating your own pie on trading 212, like making your own ETF. Yes, it was a really good question. It is a little bit. So essentially, I kind of spoke about pies earlier on, right? So a pie basically allows you to essentially have a list of companies or a basket of companies that you want to invest in. And then you allocate what proportion your money goes into that basket, right? So it's divided. So with an ETF is essentially an exchange traded fund. So it's not exactly the same, but the principle of how a fund is built is what they're trying to replicate with a pie. So you're able to accumulate a basket of companies that you invest into, and your money is distributed across those companies. So it is and it isn't. But yeah, hopefully that helps, JX. Jacinta, what shares would you suggest I invest in that's not high risk? I'm in my early 50s and something to work for me. Okay, look, first and foremost, all shares are high risk because you're always going to have a possibility that you're going to lose money. If you are in your 50s, though, then it's hard to say because I'll be asking you when your retirement date is, really, and how soon you're going to need that money. So if you're looking for relatively safe-ish, and I say relatively with, trepidation, I would probably be looking at maybe some of the bigger, well-established companies, maybe some of the dividend-paying companies. So maybe dividend aristocrats, and those will be, the Coca-Colas of this world. There'll be the Caterpillars, the Walmarts, the Targets, those companies. The more established, long-running companies with really, really strong balance sheets. Those are probably the ones that I would be looking at. But again, please don't take this as advice. All stocks have a risk when it comes to investing. And even some of the big ones, they may decide, well, actually, you know what, we don't like what's going on, or something might happen and the share price might fall. So it's really, really difficult to say, but I would go with one of the long established companies. So maybe Google dividend aristocrats or dividend paying companies specifically, particularly if you're in your early 50s and you might actually need it for retirement income purposes as well. And one. Okay. Hi, Pete. How are you? This is Daniel, 13 years old. Daniel, mate, welcome. The fact that you're actually watching this YouTube channel on a Sunday, mate, for me, that's brilliant. Right. What's your question? I recently started trading Forex on a demo account and looking for advice. Okay, cool. Right, mate, you're awesome. Amazing. Right. So you're starting early, which is great. If you are going to get into trading, mate, right, this is going to be my biggest piece of advice for you. Make sure that you really, really understand how the Forex market and trading works. Really, really try to understand it. I'm going to give you a channel that you should go and follow on YouTube. It's called FX. Actually, let me just find it because it's Jack's channel. Bear me 1 second, guys. I have to find this channel for Daniel. I'm sure he called it FX Education. Let me just double check though. I should know this because he's my mate. Let me just double check. I don't want to send you to the wrong place. Yes. So the channel, Daniel, is called FX Education. Okay. Go and follow that channel. It's by Jack. And Jack is essentially, he's a young lad. He's like 25, I think he is. But he's been trading for a while. And he started off, I think, at 15. So not too older than you. And he has basically got an academy. And he's releasing all of his Forex Trading Academy videos. So 365 videos for free on YouTube. So do me a favor, go and follow that channel. Have a chat with him. Tell him that I sent you. And yeah, you'll get a lot of stuff from him. But trust me, really make sure that you understand how Forex markets work. Don't get caught up with this whole social media thing of you can make a lot of money really, really quickly. Don't focus on that. Focus on mastering how it works, how to trade properly, how to manage your loss aversion, how to basically develop your own strategy and focus on the process of actually learning. You do that and you're going to absolutely kill it. You're 13 years old, mate. You're an absolute star. Cheers. Millie, Cash ISA, trying to save for a house, but we'll send you a message. Okay, cool. That's good, Millie. Larry, how accurate are predicted average annual returns on investment pies in Trading 212? I don't know, Larry, if I'm completely honest. I don't think that there will be absolutely spot on, because there will have to be some kind of deviation in whatever it is that they predict, because we don't know what's going to happen in the future. And a lot of them will probably be having a look at that predicted return based on a set of scenarios. If those scenarios were to change or to deviate, then obviously it's not going to be accurate. So I would not make any concrete decisions simply based on that predicted average. I mean, it is a predicted average, so just take it with a pinch of salt. It's not going to be absolutely spot on. You can definitely use them as a guide, though. You can definitely use them as a guide. I would say that, but only use them as a guide, nothing else. RTP. Hi, Pete. What's your views on investing in penny stocks? Good question. I personally don't touch penny stocks because they're just way too high risk. I think if you're going to put, $1,000 on penny stocks because you want to speculate for that, that they could do really, really well, you might have a winner. But, what is the propensity of you actually picking up a penny stock that is actually going to win, like big? I don't know. I would argue very, 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 very slim. I would rather go and put $1,000 on, I don't know, Neo, for example, or go and put $1,000 on a company that is actually listed on a proper stock exchange. That's my personal view, if I'm completely honest. But, that's just my view. Hopefully that helps you in some way, but please don't take it as advice. I have my LISA and Skipton. The interest rate is now only 0.35%. So this is a question. This is an answer to a comment before. Interest rates are really, really, really low right now. So I don't know if they're ever going to return to heights before. RTP is saying here, a good question. What about the pie feature? Let me know what you mean by that, mate. Just let me know. Maybe an obvious one, but I don't know about what happens to my investments if I suddenly drop dead tomorrow. Sorry, guys, don't mean to be dark, but if it's not part of your will, what happens? Right. So if you were to drop dead tomorrow and you don't have like a will, or the investment or the holding isn't in trust, then essentially you'll be classed as you die and in intestate. And therefore, the government, the crown, has a direction or lays out a set of rules on how your money and who your money gets paid out to. Depending on who you're investing with, JX, just let me know, because if you have the ability to nominate beneficiaries, then that would be a way for you to easily get around this. Because if you have the ability to nominate beneficiaries, whoever you're invested with will pay that money to the person that you nominate. So that's a really easy fix, but it depends on who you're invested with. I don't think Trading 212 have a nomination for beneficiaries facility. So this is, again, one of the downsides of using a free service, because if this is a really important thing for you, you would probably want to think twice if it's a big concern. Heb. Hey Pete, would you recommend the master portfolios that Hargreaves Lansdown provide? Well, would I recommend them? Would I recommend Hargreaves Lansdown is probably a more broad question, because there are many master portfolios, so they'll be built in a way that it will cater to certain risks. Risk appetite or risk profiles. So if you're a cautious investor, you'll have one for cautious. If you're a balanced investor, you'll have one for a balanced investor. You'll have one for an adventurous investor as well if you're an adventurous investor. Now, one thing that I do know is within the master portfolios, a lot of work has gone into building those portfolios. The companies that are put into the portfolio. So will they be of good quality? It's Hargreaves Lansdown. Yes, it would be. Would I recommend them? Yes. Would I recommend them for you? I don't know, because I don't know your personal circumstances. But generally speaking, Hargreaves Lansdown are very, 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 very good at what they do. And if they put together a portfolio, you know that there's been a lot of research that's gone into it. So they will stand by that they've got a really good portfolio built for you. Ryan, how would you track LIBF, CII, CISI for how the industry values their qualifications? I don't think that one is valued over the other. I think with CII, maybe because you do a few more exams, some people think, oh yeah, well, at least you've read more books. But in the scheme of thing, qualification is a qualification, mate. If you want to be a financial advisor, it doesn't matter how you get there. If you're doing the CISI, then obviously, you're probably heading into investment management and things like that, and a specialism. But they are all rated pretty much at pretty much the same level. You might have individuals, if you're hunting for jobs, that might say, oh, you've done CII over LIBF. But generally speaking, they're all rated the same. Kyra, I currently have a Vanguard Life Strategy Stocks and Shares ISA, but I don't want to give this up in the new tax year. But I don't want to give this up in the new tax year. Is investing with Trading 212 outside an ISA worth it? I wouldn't. If you're in an ISA right now, you need to think about the benefits that you're getting with an ISA. The whole point of an ISA is the fact that you don't have to worry about capital gains tax, income tax. It's completely tax free. And if you go and invest with Trading 212 and you do that outside of an ISA, you are going to have to pay tax. It makes absolutely no sense not to invest in an ISA at all. I mean, Trading 212 do have an ISA as well, by the way, so you can buy individual stocks in an ISA with Trading 212. But investing outside of an ISA it doesn't make any sense. You need to invest in an ISA because at the end of the day, if you are lucky enough to form this habit of investing into an ISA every single year, and you amass quite a bit of money into your ISA, if in the future you need an income from this, and I've seen this happen with clients, the income from the ISA is completely tax-free. So you need to absolutely invest in an ISA. So in this question, is it worth investing outside of an ISA? No, it's not. You need to invest in an ISA, and Trading 212 do have an ISA. That will be my answer to that. But with this being said, and this is another thing that you need to be mindful of, Kyra, right? You're in a Vanguard Life Strategy Stocks and Shares ISA, which means that your cost is really, really, really low right now. You're going to go to Trading 212, which is not a fund, so you're not going to have the diversification that you've got in the Vanguard Life Strategy Fund, right? You're going to go to a higher risk option where you have to go and pick your own ETFs and your own stocks and invest outside of an ISA. It makes no sense. So please do some research around where you're going from, potentially if you're looking to move, and what you're going to, right? Trading 212, yes, it's zero commission. Yeah, I know that's really, really attractive to many, many people, but you do get what you pay for. And in this instance, you're not paying anything at all, and you're stepping up the risk profile quite a bit. I mean, it's like going from like a really comfortable bed to a bed of nails. That's kind of what this would be in an analogy. So please be careful, but you need to invest in an ISA. You absolutely have to invest in an ISA. Charlie, I'm 18. Should I put more money into a lifetime ISA or an index fund? Mate, Charlie, 18. This is awesome. Right, okay, so depends what your goal is, mate. I'm guessing at some point you're going to want to buy a house. So lifetime ISA. First and foremost, make sure that you max that out because it's going to be free money from the government. And if you want to buy a house in maybe 4 or 5 years' time, you'll be happy that you actually put the money into a lifetime ISA because you'll have a load of free money from the government, right? Now, within a lifetime ISA, you've only got £4,000. If there's any other money left over, then think about putting that into an index fund. But the first rule of financial planning, what we got taught is tax efficiency. Where you don't pay any tax, you put your money there first. Particularly for you, Charlie, you're 18, you're probably going to want to buy a house at some point in the future. So definitely consider a lifetime ISA and get that free money from the government. Because who says no to free money, right? Elliot, hi, I just started watching your channel this week. Do you think it's worth investing in Tesla right now on Trading 212? Mate, listen. Oh my God, I could wax lyrical about Tesla for a while. Do I think it's worthwhile investing in Tesla right now? Yes, absolutely. But, please be mindful. Please be mindful that Tesla at the moment is $880. Like, when the market's open tomorrow morning, it might be $750, right? You have to take it with a pinch of salt. So please, guys, take it with a pinch of salt. Do I think Tesla is a good investment? Absolutely. My Tesla stock has tripled since I bought in. I bought in pre-stock split at $850. It split at $400. It's now back up at $880. So I've done really, really well. But, you know, that isn't going to be the journey for everybody. If I had to use an analogy, the analogy is this. If you see a boat where there's a party going on and you want to have a good time and you're worried about not having a good time, then you need to get on the boat. If you don't want to have a good time, then don't look at the boat. Just leave the boat alone and just go on your merry way. But, you know, if you're looking at Tesla and you're thinking, should I get in? Should I not? Should I not get in? Get in, right? But please don't go and put all of your money in there and leave yourself penniless because, again, you're buying one company, an individual stock. It is very, very, very risky. So you have to be comfortable with the idea that if the market's open tomorrow and literally the stock price goes to $750, you have to be comfortable with that. You have to be comfortable with the upside and the downside. Let's have a look at this. Nell, any opinions on free trade and investing in stocks? You know what? I don't use free trade. It's a little simplistic. So this is just my experience, and this isn't a knock on them. I think that there are other apps that do a better job at giving you information. Within free trade, you don't really get a lot of information. You don't get the financials. You've got to pay for that. With Trading 212, you get the financials included. You can have a look at the company accounts. But then again, even with Trading 212, they don't give you analyst ratings. Stake do. So it swings and roundabouts. A lot of this is really down to your personal preferences and whether you think that you can get on with a particular app. If you think that you do, then, you know, definitely go and use them. But my experience of free trade is that they could probably provide you a bit more information to help you make a decision without having to pay for one of their premium accounts. But that's just my view. I want to say thank you to the guys who just gave a super chat. Really do appreciate it. Thank you very, very much. Right, let's see where we are. Lewis is saying long term there. So you don't like penny stock. What's the minimum price that you are willing to pay for a stock? There is no minimum price, Alex. The stock is a stock price. I don't control the stock. If a stock price is at $200 and I think it's a really, really good company, then I will pay $200 to invest in that company if I think that the company is worth the investment. I don't look at investments based on what I can afford from a price point of view. That's the wrong way to look at it. If you're going to invest in a company, you need to have a look at what they do, what service they provide, what product they make, how they're positioned in their market, whether they have any competitions, what their projections are looking like, what their historical track record is like. You need to have a look at whether they're making money, how much profit are they making, are they paying dividends? There are so many variables in this. It's not just about the stock price. To a certain extent, the stock price doesn't really tell you anything. Stock price is all about, the current valuation on a company. And yes, it does take into consideration in some cases the future value, but you don't control the price. So I don't look at stocks based on, a minimum price to go and buy one. You could go and pick up a load of garbage. You're just looking at, a minimum price. Stock has got to be $20. Yes, you might be able to pick up some good ones, but you might miss some really, really good one, some really, really good opportunities as well. Max Velocity, thoughts on the little book of value investing if you've read it before? I haven't read that. Would you promote the analytical framework they advised in the book? Many thanks. I haven't read that book, mate. That might be one that I actually put on the list to actually read. A little book of value investing. I will read that. Chalky, hey, how you doing, Lee? Hi, Pete. Have you any thoughts on Nutmeg's new Smart Alpha portfolio? It's a collaboration with JP Morgan, and the fee is the same as the Nutmeg fully managed portfolio. I've not had a look at it, but if JP Morgan are involved, they're probably going to be really, really good. I'd be interested to see what's actually in the portfolio, because even though it might be the same price as the managed portfolio, what it's invested in terms of companies inside the portfolio may be very, very different. So I need to have a look at it, but I've not had a look at it, mate. So I can't really give a really good view on it. I'm sure it'll be very, very good though, because it's JP Morgan. My brother's asking me there, are you involved in property buying for others? I'm not. I know a lot of people who obviously deal with property and stuff like that, but I don't buy on behalf of people. This is just skipped. Bear me 1 second. Let me just go down here and just see how many questions we've actually got so I can just gauge time. Okay, there's quite a few. So let's just go back up here. Thank you, Media Now, for that super chat. And thank you for JX for that super chat as well. Really do appreciate it. Where are we? Okay, I've got a lot of questions to go. Let me just find where I was. Where was I? There's a question on there about 401k. That's an American thing. Where are we? Okay, here we are. Okay, bloody surprise. Hi. Would you address the in-specie transfer or portfolio in and out of trading 212? They have been promising this future from the beginning of time, but still nothing. I don't, mate. I couldn't speak on behalf of Trading 212 because I don't work for them. I'm not part of the team. It might be worthwhile reaching out to one of their team members though. Adam, hi Pete. What's your view on emerging markets leading the global recovery after coronavirus? Thanks. I'm not surprised that they are. I mean, at the end of the day, it's one of those things that they've actually recovered quicker than anybody else in the world. To be honest, if you look at certain sectors of the world, I think if you are investing though, and you're investing in funds, you're going to have exposure to emerging markets, hopefully. But, you know, picking stocks in some of these places, if you're looking at individual companies, can be very, very, very tricky at all because of the governance and stuff. RTP, are there any issues with investing in companies going public via SPAC? You need to do your research on SPACs, mate. I mean, they're all the rage right now, and you're probably the 10th person that has asked me about SPAC in the last, week and a half. And it's mainly really, really popular because of Bill Ackman. And a lot of money is being raised at the moment because they're treating this as a substitution for finding companies via an IPO. So they're essentially raising companies to take companies over. If you are going to invest in one of those companies because they've got an SPAC going on, then you really need to do the research on, number one, the team that's buying the company to take over the company that they're buying and the company that they're buying as well. SPACs have been very, very notorious at disappointing people for returns historically, and they haven't been in favor for a very, very long time. It just so happens that people are raising a lot of money now to acquire companies and take over companies via an SPAC. So just make sure that you do your research. That's all I would say. Benedict, anyone want 100 XLM3? Okay, cool. Let's have a look. Martin, do you think the likes of Trading 212 apps are causing the US markets to be oversold? Correction territory. Yeah, potentially. I mean, look, if you look at, what they got in the States, Webull, Robinhood, if you look at the rise of all of these apps that allow the general public, just literally retail investors, to pump money into the markets, give access to the market, the volumes that they're seeing, I don't think they ever anticipated. And with that, you're always going to have some people making a load of money because as stocks and assets get into the news, there is a rush for them, and therefore people then profit take, and then you see the other side. So the impact of the apps of like Trading 212 is not to be understated. Really, really is not to be understated. So, and the market has to get comfortable with that. So definitely. Al, how much do you factor in current currency exchange rates when desiring to invest in foreign stocks? The GB-EU exchange rate has been very volatile given Brexit. Personally, this is where you can get into an area where you start to try and time it and wait to see if the exchange rate basically increases. I think if you're going to buy like foreign stocks and you're buying it in the USD or yen or whatever currency that you're buying, you just have to factor that in. It's part of the whole process. You can't just, some people do, and some people, get lucky where they buy in at an advantageous rate, then get out at an advantageous rate. But it's really, really hard to do, mate. I mean, I think for me personally, I don't really look at it. I buy what I buy. And if the exchange rate is good, it's good. But for me, I don't look at it as a massive, massive factor. If you're trading, then possibly you're looking at a little bit more. But for me, it's not a big thing that I have a look at because I can't control the currency rates. JX, if I invest in index funds in addition to one share of companies like Apple in a fund, am I doubling up on myself and not getting the best benefit because you have small percentage of the share? No, not really, because if you're invested in an index fund and an index fund has a 10% weighting of Apple and you go and buy a fractional share, proportionately you have a higher concentration potentially, depending on how much you're investing, by buying that stock directly. So typically speaking, if you're going to invest in an index fund, then hopefully you know what companies they basically hold. I mean, most of them will tell you what the top 10 holdings are, right? So you'll know that I've got Apple, and if it's in the top 10, you'll know that you've got a 10% or 15% exposure, right? You'll be able to find that information out. If you wanted more exposure to Apple, then you could go and put a load of money into it. And if you put more money into it, then obviously you're holding concentrated shares for the proportion of money that you hold in that individual purchase for that company. So you can kind of like get a benefit, but it depends on the amounts that you're working with. Million, I just got my spouse approved benefit and I got his. I don't know if that's a question for me. Aguila, okay, first time investor thinking to invest 20k lump sum in an ISA in Vanguard. Would you rather invest in the lifestyle strategy 80% or an S&P 500 plus US, including investment grade credit index fund and other portfolio suggestions? Right, okay, I can't say what you should actually invest in. What I would do would probably be very, very different to what you do. I guess the question for you is, what do you actually want to achieve? So what's the difference between the lifestyle strategy fund, which is the 80% one, and the S&P 500? You need to ask yourself, what will each of them do for you? Because within the 80% equity lifestyle fund, you're going to have equities in there, so a bunch of companies, but you're also going to have counter risk measurement with a bond of some kind or a bunch of bonds as well. If you go straight into the S&P 500, then you're buying the top 500 companies. So does this fit within your goal? What are you investing for? How does it tie into your goal? That would be the question that I would ask for you. If it was my money, I don't really know what I would do, because it depends on what my objective is at the time. Those two funds are built to do completely different things. The returns on them will be completely different as well. But you need to understand what your goal is so that you can identify which of the ones, which of the portfolios you'll go for. Cost is also a consideration. So how much is the LS80 fund? How much is it going to cost you to access the S&P 500 fund that you just mentioned there? You want to do that analysis as well to help you come to a decision. What is the performance on each of those funds too? Has one outperformed the other? If so, by how much and why, potentially? These are all the questions that come into it. So it's not just a go pick this fund. You need to kind of know what you want to achieve and how it actually helps you get there. But if you need help, just let me know. Ping me separately, and we can do some coaching or something like that on that. I can help you narrow down the two funds based on what you want to achieve. Jacob, hi P, what do you think about investing around 110 stocks? Around 110 stocks. First, my first year investment, I have 10k, 15% on green, lots of recovery, growth, dividend, aristocrat UK and US stocks. Okay, that sounds like a pretty good diversification for me, mate, to be honest. So you got 50% in green energy, which would be good with a Biden administration over in the States. You got recovery stocks, growth stocks, dividend, aristocrats. I would be looking at percentages. What portion have you got in each of them? Are they evenly weighted? Have you got a preference for each of them? I don't know. You see, when you're looking at, investing in a range of companies like that, if you have a goal and you know, right, I want to be able to achieve X, Y, Z, then you would have your weighting accordingly. So, some people might say, for example, I'm looking for a little bit of growth. I'm willing to take a punt and I'm willing to put majority of my money in recovery stocks because they feel that over the long term, actually that will do really, really well. Others might say, you know what, I'm going to put majority in green. So I'm going, opposed to having 15%, I'll have 30%. It really depends on what your goals are. I'll be asking to see, what your distribution across those different sectors and what companies you have in there as well. But it sounds like you know what you're doing and you've done a little bit of research to come to that conclusion. So well done. Jovi is saying there, Robinhood are the biggest culprits. I mean, there's a lot of stuff going on at the moment with Robinhood. Thanks, Pete. JX, thanks, Pete. Do you recommend Vanguard or Wealthify for stocks and shares ISA? They both have similar fees. This would be investing in index funds. Wealthify, I'm sure Wealthify will be more expensive than Vanguard, surely. I mean, Vanguard is extremely, extremely low cost. Vanguard, you're going to have fund manager costs included with that. So I don't know which ones you're looking at, mate, but let me know which ones you're looking at. I would have thought Vanguard would have been cheaper than Wealthify. And if you're looking at cost alone, then you would go with Vanguard over Wealthify. But that's if you're just looking at cost and cost alone. So there's a question here from Alex. Love your videos. What's your opinion about nano dimensions and bio-nano? Is it the type, or what about drone delivery? I haven't followed those particular stocks, so I wouldn't be able to tell you, mate. There are so many stocks out there. Unless I have one that comes across that I start researching myself, I haven't got any thoughts on that one particular. What are your thoughts on ExxonMobil? Well, all oil stocks have actually had a bit of a tough time, haven't they? If you hold them, could they come back? I think they will. They're a big company, but if you're going to hold them, make sure that you hold them in a proportionate way for your portfolio, and just check out the news. I mean, they've been around for a while. They do what they do, but I think long term, will they be able to survive? I don't know. They'll have to diversify their business. Million. I got a bank statement around I got a bank statement about 401k. How can I transfer into my RRA account? That is an American. So a 401k and an IRA are basically American versions of a pension. I'm in the UK, so I don't know the pension or your legislation over there for a 401k or an IRA. So you would need to seek one of your CPAs, because I believe that's what they're called out there. I do know a couple. I know one that's really, really good, Emlyn. So if you want me to put you in touch with him, he'll be able to help you. Ping me a message or just ping me a message on IG or just email me at peak@conversationofmoney.com. But yeah, he'll be able to help. I can't speak on 401ks or IRAs because I don't know what the setup is like in the States. Sinner 007, if you create a pie on Trading 212, are you able to set up stop losses for the companies that you have selected? If you're in the invest account, no. If you're in the trading account, which I don't use on the CFD side, you may be able to. But I don't believe that you've got that function on the invest side of Trading 212 because it's not meant for trading. It's meant for investing, and trading and investing are two different things. DJ Yems, how are you 41? Can you give tips and advice at 20? How to look? Oh, mate, listen, it's cocoa bar. That's what I put it down to at the end of the day, and good genes. I guess I'm blessed in some regard in that way. Hasbaps, I'm an individual looking to get on the property ladder. Would you suggest I look into shared ownership, help to buy schemes, or wait that little bit longer via the more traditional route? Really, really good question. I can't tell you what to do, but I can give you my thoughts. Look, if you're in a position where you could get into owning your first property and you can own it outright, or you at least don't have to take the route of shared ownership, then be patient. I know that's hard to say though, right? Because at the end of the day, you don't know what's going to happen with property prices and stuff. Many people use the help to buy scheme, and that's interest free, for 5 years or so. Then you start paying interest at a very low amount afterwards. So I know that many people have actually used that scheme. The shared ownership one is fine, and you can staircase to bigger ownership within the property. But there are some downfalls. I think you've got to sell the property at a fair market value. So you may not get what you wanted if you wanted to exit. It's dictated by the person that you actually own it with. But it swings and roundabouts. I mean, I don't know how far you off your journey, but help to buy, for many people prefer to go help to buy. And I used to be a mortgage advisor, and I would help people a lot with help to buy because that seemed to be the default that everyone would go for. But again, I can't really say what you should do, mate. It's really down to you. It's down to whether you want to be patient or not. But Help to Buy is not a bad shout at all. Carly, yes, FXC education. So yeah, so that's Jack's channel, the Knox Trader. Swing trade, technical analysis, keep up demo trading until you're 18 and don't use signals. That's a really, really, really good piece of advice there as well. Lev, hi Pete. I'm beginning to invest in. What do you recommend I do? Would you have a would like to have a passive income using the Practice 212 account? Thanks. Okay, so first and foremost, mate, let's just get real for a second. I get so many people saying, I want to have a passive income. And when I say how much do you want, they'll be like, I want 500 quid or £1,000 a month. Right. If you're going to invest and you want a passive income, for you to have any meaningful amount of a passive income, you need to have capital. If you're a first-time investor, you may have enough capital to put in, but if you haven't, then you have to be patient. I always have to ask this question for people who actually ask me about passive income, especially if you're young. Why do you want passive income now? Because let's just be real for a second. If you're in your 20s or so and you've got 30, 40 years until the point that you actually feel as though you want to retire or basically jack it in, your younger years are the years that are so crucial because you have the energy, the time, the power to actually increase your earning potential, right? So that you can throw money into investments to actually grow wealth that can then kick out a passive income a bit later on. I think social media sometimes has given this idea of, you can invest, X amount and get a passive income and just live an easy life. And the idea of it is great. And I'm not saying that it isn't going to suit absolutely everybody. But I think sometimes if you're going into investing, just thinking about a passive income, you are going to miss a boat. You're going to miss the biggest and most important boat of all. You're going to be investing money creaming off your income, like literally your growth, and you're not going to be compounding to actually create some tangible wealth for the future. There needs to be a massive change in narrative on YouTube, on Instagram, and all kinds of social media around passive income. Really, really, really do need to be mindful of this. And so, look, Lev, please just, I would question what you want to earn in passive income. I'm not saying that it's not possible. It is. But what I do want you to think about is, why do you want passive income? Why? Especially if you're in your 20s or in your 30s. Now should be the time when you're creating wealth. This is your wealth creation phase. You only get one phase. You don't get it when you're like 45, 50. You get it right now. If you're in your 20s, this is the opportunity. You have time on your side. Invest for growth. The passive income can come later on. It can come later on. So that's all I'd say on that point. And I know it may not be something that you necessarily wanted to hear, but look, I have to be honest and I have to give you my thoughts, and those are just my thoughts. JX, thanks for coming back on the question about wills and dying. I haven't set this up with this year's Stocks and Shares ISA yet, so between Wealthify and Vanguard, in terms of beneficiary nominations, I'm open to other suggestions. So if you're using Vanguard, I'm sure that Vanguard have a nomination form that you can fill out for your investment. I'm pretty sure Wealthify will have one as well. But, you should definitely, if you don't want to go and pay for a will, literally nominating a beneficiary for your investments is the easiest way to do it as well. So if you're using Vanguard or Wealthify, literally make sure you ask that question. We've got Daniel. Hi Pete, love the podcast and really appreciate the free education you're giving me over this lockdown period. Thank you, mate. Thanks to you, I really got my act together and started to get a grip on my finances. Mate, this is music to my ears. That's the whole reason why I do it. So thank you very much, and thank you for actually paying attention and listening. There's follow up here. I'm planning on putting money into a Vanguard Stocks and Shares ISA long term. Are you best opening a new Stocks and Shares ISA and transferring the current Stocks and Shares ISA over to it, or do you just leave it open and the £20,000 resets each year? So yeah, okay. So one really important thing, guys. You have a £20,000 allowance every single tax year. The tax year runs between April the 6th and April the 5th every year. So you have 20 grand every single year. You can have 20k with HSBC this current tax year, and come April the 6th, go and open another ISA with, I don't know, Barclays or Trading 212 or Vanguard or whoever you choose the following year. You can leave them separate. So I know that many people have had like, you know, ISAs over the years where they've got one with HSBC, Barclays and Hargreaves Lansdowne and all kinds of investment places. You can leave them all over the place. If you want to manage them a bit more efficiently, then most people would decide to transfer them and pull them into one place. So you've got choices here, if I'm completely honest. It's completely up to you what you do, but the 20K resets every single year. Let me just give you one really big piece of advice, which is okay for me to give. If you are going to move from your £20,000 from a previous tax year to another company, make sure you do a transfer. Just don't go cash it out, take the cash and go pay it into a new account. You have to do a transfer. And I know that you alluded to that there, but for everybody else who wasn't aware, that's something that you definitely need to be aware of. Can you transfer stock holdings from free trade to Trading 212? Just Trading 212 do optional trading. Byron, I don't know that you can. I think that you have to sell them. I think you need to check with Trading 212. I haven't heard that they do. Essentially. And does Trading 212 do options trading? Yes, you can do options trading on the CFD side of Trading 212. Huxley, hey guys, how you doing, mate? Hope everyone is well. Thought I'd recommend getting the paid subscription to Pete's channel. Mate, thank you so much. Yes, if you don't know, we've got a paid subscription. Huxley, Scott, like there is a member of ours. It's $17.99. But yeah, we go through and meet every Sunday. We talk a little bit more in depth about investing. And yeah, we've got a Discord group as well. We've got, I think, just over 20 people in there at the moment. So if you want to join, definitely consider joining. There's a button right under or right beside the subscribe button as well. What we've got here. If you've messed up by using Trading 212 Invest rather than Trading 212 ISA, is there any way to move the stocks into the Trading 212 ISA? JX, the answer to that is no. Apparently, you have to sell all of your holdings and you have to then repurchase the stocks in the ISA account. I know it's a pain, but yeah, you can't do a transfer. I don't know whether that's something that we might bring along later on because it just seems a bit silly. But as it currently stands, you've got to sell the entire holding and rebuild it. So hopefully, you know, depending on how much you're cashing in, there won't be too much of a tax thing to pay. Riaz, can I join in and ask a basic question about dollar/pound cost averaging? How do you get over the mental block of increasing your average stock price when you manage to buy in at a great price? Good question. The simple answer to that is don't look at the price that you're getting in at, because again, you can't control that price, right? You can't control that the stock goes up or the stock goes down. If you're investing on a monthly basis, just know that you're getting in on the stock on a monthly basis. Now, that's really, really difficult if the price is going up. But most stocks have a volatile journey through the year. So you'll have them go up and go down. So if you're catching some ups and downs, that's fine. But don't pay attention to the stock price. Don't watch it like a hawk. That's the worst thing you could do. But also just bear in mind as well that actually, if you're holding it for or investing for a 5 or maybe a 10-year period, actually getting it at different prices, be it high or be it low, is actually a good thing because it will smooth out the return that you get in the long run. But it is in the long run. Really good question there, Ria. Stephen, I have gone over stocks and shares ISA limit. What do I do? Do I need to contact the tax office? And will I be fined? This is a really good question. I had someone panic on the channel, message me on IG to talk about this. So if you have gone over the limit on your stocks and shares ISA, you've got a couple of choices. You can basically just close the additional bit or withdraw the additional bit, but really just speak to HMRC. Just let them know. I don't think he got a fine. They said, "Oh, that's fine. Thanks for letting us know. At least you've let us know." He didn't get a fine. But just speak to HMRC. They are okay about it. If you just say, "Look, I've done it by mistake. I didn't really mean to. I only just found out or realized like a couple of days ago, and I rang you straight away." So yeah, you'll be fine. There's not normally any other action that they take unless you're a proper repeat offender. So you'll be fine. William, so come April, I'll be able to open an additional ISA using Trading 212. Sorry for yes. So basically, in April the 6th, that's the new tax year, or on April the 6th, that's the new tax year. You have a new ISA allowance of £20,000. So essentially, the tax year resets, giving everybody an additional £20,000 that they can add for the tax year. Marky 44 with Vanguard funds. I have seen someone show a screenshot of the returns they are getting, and they show the percentage gain or loss. I have started a managed fund with Nutmeg. Okay, so I'm guessing that they had really poor performance. I don't know. There are so many Vanguard funds out there. You're going to have some funds that will perform well. You're going to have some funds that don't. I mean, you just look at my video from Friday, right? 4 of them have done really, really well. 1 of them did nothing, like 0. That is going to happen. The question is, why did it happen? And just trying to understand whether they performed poorly or badly in the context of everything that's happened during that period that you're reviewing them for. So if you're looking at the last 12 months, okay, so why have they performed badly? Were they invested in a particular sector that didn't do well, that was hit by COVID? These are the questions that you would need to ask. But, Vanguard are traditionally very, very good and low cost. If you've gone to Nutmeg, you're probably paying a little bit more on the fees and the cost side of things, which isn't a bad thing if you're okay with it. There was something on here. Actually, there's a follow-up from Marcus. Let me just get this. While I see the gains in pounds, not sure how to compare it to other companies offering a similar product and funds. How do I know if I'm putting my money into a great performing fund? So the best thing for you to do is, if you have like a fund that you've got in mind, and you can find maybe 2 or 3 others that are similar, you just need to pay attention to their performance charts. That would be the best way of trying to see how they performed over the same period of time in the same circumstances. But one thing that's worthwhile bearing in mind is you need to try and make sure that that has an identical or similar equity exposure. So for example, if you're looking at a Vanguard life strategy fund and it's 80-20, so 80% in equities, 20% in bonds, you want to find something that is similar to that. So another 80% equity, 20% bond fund to be able to compare. The actual holdings within them won't be identical. They might be similar, but you're looking at the makeup of the fund to be similar for you to be able to have some kind of broad comparison between the two to know whether one is better than the other. But again, there's a lot that goes into it, and a lot of it will be what you're comfortable with. Lisa Palmer, hi Pete, I'm just Trading 212. I'm watching your videos. What are your views on NEO? NEO, really good question. We're talking about this in the group. NEO, good company, really, really good company. There's a lot of analysts saying that, they're going to be the one of the best stocks to buy this year. I think if you're going to go into them, don't put all of your money in. At least put what you're comfortable with in, I would say. But as a company, they got really, really big backing. They had NEO Day last week. I haven't caught up on what they were talking about just yet. But if you're going to buy NEO, I think that I have a little bit of NEO. So I can't say that I'm not vested in them, because I am. But I think, make sure that you do your own research, and if it's something that you are comfortable with, put a little bit of your money in just to test the waters, just to get your confidence up. And if they do start doing really, really well, then you may have the ability and the confidence to put more money in. But with all things, don't put all of your money in one egg, please. RD, for a general investment account with the pies on Trading 212, how does the tax work? As the stocks you buy would be a percentage that would add up in the pie. Okay, so you're going to pay tax on your entire holding. You're not paying tax on the individual parts of your pie. So if you have one company that does well, then a company that doesn't do well, it will be reflected in your entire pie. So when you cash in or close your accounts to actually draw your money out, you're drawing your money out based on the value of your complete pie. So your tax will come from that amount, not the individual ones that you actually hold specifically. Unless you're looking at having a pie that has maybe got like a handful of dividend stocks in there, then you'll pay the withholding dividends tax directly when the dividend payment is paid to you, but you don't get to see that come out. Right, Ryan. Tesla has a PE ratio of 1,740 and a forward PE of 327, which is 330 years of to get your money back, assuming everything goes right. Yeah, well, listen, this is the argument. Maybe people are actually saying that it's overpriced. Is it overpriced? Maybe the analysts will say that they are. Other analysts like Kathleen Woods will say actually no, because the value in the Tesla stock is based on future projections. It's based on future delivery numbers. It's based on where they feel the EV market is going to go, which they are currently leading. So it is nuts when you look at the numbers. The numbers are absolutely crazy. But what's going to happen in the future? We don't know. We know that they are market leaders right now. I think that they will continue to hold market share. They might have a bit of it stolen by the likes of NIO and some of the new incumbents that will come along. But in terms of the tech that's in the car and what they've actually got planned, I think they're way ahead of everybody else. Mercedes, anybody else. Salvatore, let's have a look here. Right, how many questions have I got? Haven't got that many here. So, right, we'll get through these. Where are we? Okay, maybe I have got a lot, actually. Maybe I have got a lot. Okay, cool. We'll try and get through these, guys. I'm conscious we've been on for about an hour and 19, so let's give it maybe another half hour and just power through these. Okay, Salvatore, good evening. If I invest in trading 212, eventually I will withdraw the profits, transfer it to my ISA. Do I have to declare the income to HMRC for tax purposes? Yes, you do. You need to make sure that you track what capital gains that you get from your closures. And you need to make sure that you check that against your capital gains allowance. And if you do have a little bit of extra on top of it, you've breached your allowance, then you definitely need to announce it to HMRC. The easiest way, mate, is keep track of it. And if you need to speak to an accountant, speak to an accountant. Jack, hi Pete, I'm 19 years old and new to investing, looking to round out my portfolio with some bonds, but not sure where to start in terms of what ones I should go for. Mate, there are tons and tons of bonds out there, Jack. Who are you using, I guess is the question. You can get some bonds in Trading 212. I would say Vanguard because they've got so many. And you can get some bond ETFs as well. So have a look at Vanguard and try and have a look at some bond ETFs because that will get you a really good mixture of bonds as well. Bonds they're not easy to acquire if you're not going to the right place. So yeah, have a look at Vanguard. Sombo, hi Pete. Should one stick to one stock and shares ISA for whole of life, or should one invest in multiple stocks and shares ISAs over time? Many thanks. I know people move around, and I think ultimately people move around because they're looking for the best investment vehicle possible. I know that sometimes when people move around, they will then pull other things that they've had elsewhere. So it means that eventually, really, they have it all in one place. There's nothing wrong with having a ton of ISAs with different people. There's nothing wrong with it at all. The question is, can you or will you be able to track them all? For many people, it just gets a bit too messy and a bit too much, and they just think, oh, you know what, I can't be bothered, and therefore they just stay with one person. And that isn't necessarily a bad thing, but I think it's also important that you do keep your eyes open in terms of the options that you have available to you. So, yeah. Tristo, continuing from the previous question earlier regarding a pie-like and ETF. In an ETF or an index fund, is there a typical number of companies held within one? No, there isn't, because if you look at index funds like the S&P 500, they hold 505. You look at some other index funds or ETFs, and they might only have maybe 100 or 50 or 60. There is no set number. It really depends on who's actually building the ETF and what it's designed to track as a passive investment. V-Day, hi Pete. Many thanks for answering my last question on airplane stocks. What are your opinions on Hargreaves Lansdown LISA? Have I looked at the Hargreaves Lansdown LISA? I don't think I have yet. I've looked at their ISA. I mean, it's Hargreaves Lansdown straight away, so it will be good quality. I think with Hargreaves Lansdown ISA, just have a look at the cost and have a look at the performance. But Hargreaves Lansdown are a really big, reputable company. So whatever they do, they generally put a lot of research behind and stuff. So, but don't just obviously just use them just because they're Hargreaves Lansdown. Do shop around and try and find the best one with the best kind of exposure, particularly for what you want to achieve. And depending on, obviously, if you're using it for property purchase purposes, how you're going to do that for property purchase, how long you invest in for, if that makes any sense. So if you're looking at 3 years, 4 years, then you need to make sure that you're picking something that is appropriate for your risk and your timeline, if that makes sense. So Hargreaves Lansdown might have a little bit more variety, whereas if you go to somewhere else, they may only have a fewer number of options for you to invest in. So those are a couple of things to bear in mind. Part two, I know they are expensive compared to other platforms, but I find their research aids really useful. I'm hoping to get to use it to invest in REITs. Okay, yeah. Any comments on this would be really useful. Yeah, so Hargreaves Lansdown, many people say that they are expensive and they can be more expensive than other people, right? But at the end of the day, you do pay for what you pay, what you get. I mean, the cost that they put in reflects the charge that they basically ask people to pay for their service. And unfortunately, people like Hargreaves Lansdown have been around for a very, very long time. Their research is very, very good. I mean, I get emails from them all the time, and every time they send me something, it's always very, very insightful. So that's very, very different to using someone like Trading 212, where you get nothing. Like, they don't send you an email with any research, nothing at all. So for many people, they would rather pay that little bit extra because they're getting that extra level of service from them. In terms of REITs, REITs are great for you to access, property within a fund. REITs, though, just be mindful. Within a REIT, you're going to have, corporate property, commercial property. And with COVID, they probably would have taken a little bit of a hit. So make sure you have a look at the performance on the REITs, that kind of stuff, and what they're invested in, where they're invested in it as well. Luke, let's have a look. Hi, Pete. Thanks for the advice you have given me already. Have you done a lot for me last year, man? Could you tell me more about the course that you do on your paid subscription? Thanks. Okay, so cool. Really good question, Luke. So I have an investment course, which I literally this year reduced from $99.99 to $59.99. So if you join the members group, you automatically get access to that course. And in addition to that, you also get access to me. We meet every Sunday, the members do. Sunday evening, 8 p.m., we basically chop it up, talk about, stocks. If people have any questions about particular stocks, they can ask me. I can take things away to go and research. And as part of that as well, I'll be inviting some of my mates. So one of my friends, Terry, is going to be coming into the group fairly shortly. He's an ex-investment manager. He used to manage 200 million quid for one of the big investment houses here. So I bring in people that I know across the finance world, people that I've worked with, people that I know, to basically provide that extra level of kind of like education almost, really, to be honest. So the membership is only $17.99 a month. It's worth it. You get access to me and you get access to the Discord group as well. So what happens in the Discord group is we chat in the group, but oftentimes a lot of the members will message me privately within the Discord group as well, and we'll have private conversations. So you get access to me for $17.99. So if that's something you want to consider, mate, definitely consider joining. Minolti, hi, I currently have a Help to Buy ISA, which I'm paying into monthly, and I plan to use this when I eventually buy a house. My question is, should I still be investing into a LISA for when I'm older? Yes, you can have both, mate. If you're investing into a LISA for when you're older, okay, so here's a couple of things to think about. So when you're older, I'm guessing you mean as a pension or a retirement vehicle, which a lifetime ISA can be used for. The only thing I would say to that is if you are looking at using it as a retirement vehicle, then I'd be asking the question as to why you would only use a LISA and not a pension. So if you're working, your workplace pension specifically. But you could still use it as with the guise of investing for the future for retirement, but also have it as a source to top up your help to buy ISA for a house purchase, if that makes sense. If that's what you're alluding to, it makes really, really good sense. But if you're looking at it purely just for pensions and retirement, I'm biased. I think that you get a little bit more value from a pension and your workplace pension scheme specifically because there's free money from your employer on the table that you should really take advantage of. George Porter, hi Pete, what are your opinions on investing in silver or commodities in general? Loving the channel, by the way. Thank you. Listen, anything, commodities, silver, gold, very, very good investments. I mean, they are pretty much the hedge really, especially gold, because, you know, gold is true currency at the end of the day. There was once upon a time the dollar was actually pegged to gold, like literally pegged to gold. And, you know, that dictated, you know, the value of money back then. So, you know, with short supply and scarcity and stuff like that, commodities, silver, gold, really good investments. It's just a question of how you're going to access them. Are you going to buy physical silver, physical gold, or are you going to go and buy, you know, things like gold ETFs? You just need to decide on that. Joseph, I would love to buy all my stocks with Hargreaves Lansdown. Looks like it's a bit of a luxury though. Yes, you're going to pay $11.95 for the privilege of it. So it is expensive with Hargreaves Lansdown, and that's why many people are using the likes of, you know, Trading 212 as a substitute for that. It's Hargreaves Lansdown. They've been around for a very, very long time. What you are getting with them is, you know, you're getting that research, you're getting that additional bit to help you make that decision. Is it worth it? Only you can decide. So it's a tough one. Sina, what do you think about investing in airline companies before the pandemic is over? We had that question a little bit earlier on. Short answer to this, to keep it brief, is, you know, they are classed as a recovery stock. If you believe that the company is going to be around after the pandemic and the share price will recover, albeit over an extended period of time or a short period of time, then it would be worthwhile you putting your money into it. But again, you have to be comfortable with the potential risk that, you know what, the company might go bust after all of this is said and done, because they simply can't survive from the damage and the losses that they've made during this pandemic. A lot of these companies will be reliant on a bailout. How likely is it that they'll get a bailout if they need it? So they are potentially very, very good investments, but you have to understand the risk that you're taking by investing in those companies. And that's true for every company that you'll ever invest in. Simbo, right, which one is going to get higher returns in the long term? 20-25 years, LISA or stocks and shares, ISA? Mate, that's an impossible question to ask. I don't have a crystal ball, mate. I mean, at the end of the day, it depends on how they're invested and in what. So when I say how they're invested in terms of the equity exposure, it depends on whether they're medium risk, high risk, low risk. If they're in identical funds, then and they're invested in identical companies invested at this literally the exact same time, then they should both track and perform exactly the same, assuming the cost ratios of the investment vehicle are the same. But it's really, really hard to say because you don't know what's going to happen. Where are we? Let me just find myself here quickly. Okay, this is a good question. Would you recommend someone to start investing if they've got student loan debt? There's nothing stopping you from investing with student loan debt. I know student loan debt is a really, really big burden for many people. I mean, I can only imagine. I mean, I don't have any because I didn't go to university. I couldn't afford to at the end of the day. So I can imagine it's a really, really big burden. But with student loans, you haven't got to pay it back until you start earning a certain amount. And I know that sometimes that doesn't actually help with how you feel about having that debt over above your head. But for me, I would still invest. Definitely invest, because you know your ability to invest potentially gives you the ability to grow more money. And as long as you, even if you do get a job and you do have to start paying it off, as long as you have additional surplus income, then it makes sense to just invest over paying down that debt altogether. But again, some of this is all about personal preference. Some people absolutely hate having debt and owing people money and just can't deal with it. So it's one of those things that you're going to have to come to a personal decision on your own. But if you have the opportunity of paying down debt or investing, worst case scenario, you could pay down some debt and invest at the same time and do both things. Joseph, question that's avoided by every trading guru, so to say, that interests me as a beginner, just started out learning Forex. There's the what? There's the question. How much do I need to invest hypothetically to get 1,500 E on average? I'm not a Forex guy. I don't trade. That's not what I'm interested in. That's not what the channel's about. I'll talk about trading in the context of how it relates to investing specifically. But let me tell you this. The reason why the Forex guys will not tell you that this is how much you actually need to trade is because, number one, a lot of the guys that are out here at the moment are simply just out for themselves, literally looking to make money. They have no interest in really helping people. They might be selling you signals that aren't really worth the money that you're paying for. And you know what? Because it is trading, it is such a volatile thing to do. They can't guarantee you anything. Even in investing, there is no guarantee. So if you ask me, how much do you need to invest to, get a 10% return? It's an impossible question to ask. Absolutely impossible, because there are so many variables. Your appetite to risk, the market conditions, how you invest it. There are so many things where there's no crystal ball in investing. Certainly no crystal ball when it comes to trading. Certainly on Forex. And unfortunately, social media will have you believe that you can invest £1,000 and turn that into £10,000 just like that. Really, really simple. Some people can do it. But the people who do it are the guys who have been trading for years, have a system, are disciplined, understand how things actually work, and actually have the ability and the know-how to actually look for opportunities to be able to do that. A lot of the time, a lot of these Forex traders, they're just willing and they're just happy to sell like signals. And I can't wait for the day for those people to disappear and for people to really get into the fact that they need to learn the trade and it's not a get rich quick scheme. I really am looking forward to that day. What's thoughts on Tesla? Hold or sell at the moment? I'm holding. I'm not selling on Tesla. Definitely. Victor, hey, got an ISA question. Let's say you put 20,000 into at the start of the tax year, and then your investment doubles. Do you pay capital gains tax on everything above £20,000? No, the answer to that is anything you gain in your investment, because it's an ISA, is completely tax free. Also, are you able to put another 20k into the same ISA account the next year without having to pay tax? Yes, you can. VDay16, I agree social media is really distorting the reality of what investing is. Massively. It's the reason why I ended up on YouTube in the first place, because there is just so much nonsense being spouted out there and people selling courses for £999 that is just worth absolutely nothing, spouting absolute lies. And I cannot wait for the day that this all comes to an end, because the expectation, they do damage to people, because people then have a very bad experience either trading for the first time or investing for the first time, and they lose confidence to carry on moving forward. Investing and learning how to invest should be a joy. It should be something that you enjoy, because at the end of the day, it's what we don't get taught in school, and it's the key to actually living the life that you want to live, knowing that you're going to earn millions and millions in your lifetime. I mean, literally, guys. You will earn millions in your working life. You just don't have it in cash right now. Being able to retain and invest a proportion of your income is so, so, so important. Like, you would not walk around with like gold in your pocket and just let the gold flitter away. Like, you wouldn't do that. It's the same thing with your money. I liken it to Monopoly, right? Who plays Monopoly and doesn't buy an asset? Who doesn't buy any property or Monopoly board? How can you expect to win if you don't do that? How do you expect to win that game if you don't buy any property? but we don't know how, because we don't know how important it is. Because in the real game of Monopoly, which is called life, we get our salaries every month. We go around that board every single month, buy nothing. And then we complain that we get wiped out. We have to get the education. That's why I'm here. And investing, buying in property, is the key to having the life that you want. And that's my big belief. I say it all the time. Money is a tool. Life is for living. Money is the tool to help you live the life you want. What else we got here? What are your thoughts on Atom Bank for savings accounts? Atom Bank, I did open an account with them many years ago, but I didn't actually pay any money in with them. I know that interest rates are pretty low across the board at the moment, so I don't know whether they've got any special rates or any decent rates at the moment. But yeah, I mean, I might start reviewing banks and stuff like that. I don't know. They're just not sexy to me, though. Banks are boring. Lev, thanks for the reply. I think I'll join your channel. Cheers, mate. Victor, all gains on it. Yeah, tax-free. Well, I said that one right there. How do you feel about being able to copy pies on Trading 212 and also apps like eToro? Really good question. Right, I was going to do a video on this and it is in the works. So one of the things that I think is really important to bear in mind is, Trading 212 is great, and being able to see what other people are doing from a pie point of view is also great. But don't just go and copy it. The purpose of it for me is for you to kind of get an idea of what somebody else is doing. So if I was a complete novice, what I would do is I would have a look at a number of people's pie, see what they've actually got in it, and then go and have a look at those companies and see if it's a company that I go and like, right? Because if you just go and copy something, you don't know what the risk appetite for that person is, how they're actually looking to invest, what their goals are. You don't know. It's like walking off a cliff just because someone else done, right? You might be able to stand on the edge of a cliff, or they might be able to stand on the edge of the cliff and not feel the fear of heights, right? They might have no vertigo whatsoever. You might. So it's not an appropriate thing to do. So just be careful with it. Use it as inspiration. Use it as a way for you to kind of gauge what companies are maybe popular, what companies that might come on your radar, in opposed to simply just copying them. In eToro, because there's trading involved in eToro, that you can trade with eToro and just copy them, you need to be even more careful, because again, risk tolerances and personal circumstances are very important. Nice to hear some other ladies in here. Yes, we need more ladies on here, definitely. All right, okay, so I think we're almost at the end of these questions right now. So let me just catch a few more. If I can't get to them, guys, I'm sorry. But yeah, there are literally, at one point there was 130 of you. There's still 117 on right now. So we might have to reconvene and get some of these questions in the next time round. But let's see if I can maybe grab 4 or 5 more, and then we'll have to call it a day. Let me just find where I was. Bear with me 1 second, guys. Where was I? Where was I? Okay, I've literally just got to pick somewhere. I'm going to pick here. Okay, so have I already answered this? Right, let me just go down. I'm going to pick here. Right. Okay, so All Day Green. All Day Green has asked a question here. Okay, I know that's a conversation actually. That's fine. I'm at the bottom right now. Let's go to this. Okay, so Jossip's got a question on here. Let me see if I can find yours. So I was asking the question because I was watching various videos and learning about Forex for immense improvements in reading and understanding candlesticks. And with demo accounts, I've been averaging £1,000 a week. Look, a demo account is completely different to the real thing. On a demo account, you have zero money on the table. So therefore, you don't have the worry that you're going to lose money. The simple psychology of having something to lose will make you second guess yourself like never before. And you don't have that in the in the demo account, whether you're using Trading 212 or IG or eToro. It is completely different. You don't really learn anything at all when it comes to actually trading on a demo account. Yes, you get the candlesticks, but you're not going to be able to learn how to control and take away the emotion of investing when there's money to lose. So just bear that in mind. everybody says we make a lot of money on the demo accounts, trade for the first time, lose money, then they get really, really scared. And that's why people give up, because what happens in the demo account is not what happens in real life, because you have the dynamic that you're worried that you're going to lose money. You have to be able to control that part of your personality and that part of your psyche. That can be really hard. It takes time to do, and you need to have the mindset for it. What have we got here? Okay. There is a big conversation going on there. So, fantastic answer. Excellent channel. I'll be signing up to your course ASAP. Thank you. Appreciate you for that. Thank you very much. Here we go. Okay. Neil will be maybe $200 max in the next 5 years. There's a conversation going on there. Okay, I don't think there's any other questions. I think we've covered most things. We've been on for about an hour and 44 minutes, guys. I appreciate you so much. There's 107 of you still. Thank you very, very much. Thank you to everyone who contributed on the super chat. It really does make this worthwhile. In addition to obviously being able to help you guys as well, it helps the channel and helps me make this sustainable as well. So I appreciate every single one of you. Thank you so much. There's a lot that we've covered here. The membership is open, so if you want to join that, like I said, it's $17.99 a month, and you get access to me, get access to the Discord group. There's a good bunch of people in there, all on their investment journeys as well. So if you want to join in, definitely come and join in. The investment course has been reduced from £99 to $59.99. The website is actually up and new. So if you go to conversationofmoney.com, have a little look around there as well. It gives you a bit more of an explanation of what we can do if you want to work with me on a coaching side as well. But guys, have an amazing Sunday. Well, I would say Sunday evening. The night is basically over, but have an amazing week. And yes, the next live is going to be on the 24th of January. So I will see you in a couple of weeks' time. Thank you for joining me. Take care.